Hi, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back, sir.
Great to be here, Mehdi. Thanks for having me on the show today.
It wasn't the most active week since we last spoke, although the market seems to be looking a little bit weaker as we record this. But you obviously published your weekly playbook on Sunday night, which is available on Substack at hugeinsights.substack.com. And we're going to have a little chit chat about the salient points within your piece. But before we get in, Jeff, don't forget to like and subscribe on Your Finance TV to stay on top of our content. But without further ado, Jeff, why don't we kick off as usual with your top down?
Well, as you know, Mehdi, we actually published our newsletter this weekend as well. Newsletter is called Huge Insights, the Big Picture, and it's available on Substack to anybody. We have a nice free preview that gives you kind of a, maybe 5-page look at what we're thinking about from the top-down perspective, from a macroeconomic and geopolitical perspective as well. And so we go into a lot of detail there. And then, our paid subscribers get further access to our market analysis and our positioning recommendations. And this is a more of a retail type newsletter that's available really to any investor. And I think it'd be helpful to anyone who's really even just doing asset allocation, let alone, long, short, or equity specific allocations. But it's kind of an introductory view to the Alpha Insights product, which is more of an institutional product, and that's where we dig really, really deep into some important relationships in the capital markets as well as the equity markets specifically. This past week, we saw the S&P give up some of its gains. We were down about 2.3% last week in S&P terms. Our thinking is that the market probably reached its counter trend peak in late July 27th. And that's kind of our work points to, a second wave peak that was achieved on July 27th. And we think that the decline that we saw last week and really this morning, as we see a little bit of follow through, is really primary wave 3 down, the very early subdivisions of primary wave 3 down, which we believe will carry the market to new bear market lows. Now, this is a very contrarian view. It flies in the face of almost everyone on Wall Street today, even the bears who have almost fully capitulated at this point. And, economists who have been calling for, a recession earlier in the year have flipped, 180 degrees, now pushing that out to a 2024. We think that's wrong. We think there's a recession that's underway as we speak. We think it's been a rolling recession. It's been hard to pinpoint. We know that it's not showing up in the traditional measures of growth, real GDP, nominal GDP necessarily just yet. And we're certainly not seeing strong evidence of a recession in the employment data. But we are seeing some weakening in the employment data. And that's it's kind of a piece of the puzzle. It's usually a lagging indicator and the last kind of domino to fall. And so, our thinking at this point is that we're going to start to see a building body of evidence that recession is unfolding over the course of the back half of 2023 and into early 2024. We think that all of the indicators point in that direction. And if that's the case, we're going to see a massive earnings revision to the downside. Typically during a recession, you see earnings revised down some 30%. Not just revised down, but earnings decline by 30% on average, looking back at every recession over the last 70 years. So, our positioning right now is pretty conservative. We've been advising our clients to, be patient, to minimize net equity exposure. That means a lot of different things to a lot of different people. For long short funds that might be able to go directionally biased, we're suggesting market neutral right now. For long only investors who can sell stock and maybe buy call options to maintain that, upside exposure if we're wrong. But it's a way to raise cash and reduce, capital exposure to the equity markets. And then, we're suggesting the fattest pitch in the market that we can see right now is 3 to 6 month T-bills that currently pay 5.5%. We think that's probably the best combination of value, liquidity, yield, and for all practical purposes, we think it's a nice place to kind of ride out the storm temporarily and wait for opportunities to emerge. So that's been the advice that we've been providing our subscribers.
That's great, Jeff. Thank you. And obviously, you're highlighting the fact that valuation matters, and you kick off this week's piece with a very interesting chart that I haven't seen before on why you're saying valuation matters. So talk us through this.
Well, you've probably seen it before, but that was probably back in college. This is really just a scatter plot or regression analysis, looking back at monthly data that goes all the way back to 1928. And it's the capital asset pricing model, right? It's the equity risk premium, and the equity risk premium is really calculated as this spread that you should be able to earn on equities above and beyond what you would earn on a risk-free asset like treasury bonds, right? So what John Hussman has done here in his work is he's regressed all this data back, and he's estimating the current equity risk premium at negative 7.5 using, kind of a standard data that everyone would have access to and use. There's, nothing particularly proprietary about the way he's calculating the equity risk premium. It is what it is, right? It's an academic exercise. What's interesting to me is that, the current equity risk premium is the worst on record. Historically, it's the very worst in the entire history of the data series, and that includes the March 2000 peak at the top of the tech bubble, which is the next closest data point. And what Hussman points out is that if we look back to March 2000 as being kind of at least a guide to where things could be, we could see equities underperform bonds for the next 12 years. Just the way they did after the tech bubble peak, where they underperformed the average 10-year treasury total return by 600 basis points annually for 12 years.
That's very interesting. We really should be keeping more of a focus on this, actually. So, Jeff, you've been talking about a gamma squeeze for a while now. Talk us through this chart here, or your thought process here on this fund flows.
Yeah, I found this chart in a deck that was produced by Tier 1 Alpha, which is a really great research service. If you're interested in all the wonky sort of stuff of the options market, and we've been doing a lot of research on it. They've been very helpful to us. And really, what the chart shows is that there's a cadre or a cohort of investors out there known as quant funds. Generally, they include CTAs, commodity trading advisors, risk parity funds, and vol control funds. Okay, so collectively, we'll refer to those as quant funds because what they're really doing is they're using a systematic approach to adjust their equity exposure based upon changes in volatility, right? And so, what happens is as volatility increases, the quant funds sell equity exposure. And as volatility decreases, the quants buy equity exposure. Well, there's a positive feedback loop and a negative feedback loop that comes of that, because what happens is you've got options market makers, dealers, if you will, okay, that are basically offering calls and puts, right? That's their business. They're trying to make the spread, right? They're not trying to directionally bet on the market. And so what they'll do is they'll offer a call option on, Amazon, for example, and someone buys that call option. Now they've got to hedge their book, right? And so what happens is when, markets and stocks are going up because of low volatility, because quant funds are buying equities, well, that puts them in a position of positive gamma, right? Which means that they need to constantly buy more of the underlying security that they are exposed to vis-a-vis that option that they sold. They sold a call option on Amazon, so they need to continuously buy Amazon as Amazon appreciates, or sell Amazon as Amazon depreciates, right? And so what happens is, as we see these regime changes, right, it adds a lot more fund flows into the mix. So, for example, we've recently seen an uptick in the VIX, right, in volatility. And so what that's forcing systematic traders, these quant funds, are now selling equities as volatility increases. And what that's doing is it's putting dealers in a negative gamma position where they now have to sell the underlying stock. They have to sell the Amazon stock that they own in order to maintain a delta neutral hedge exposure. And so it's a vicious cycle now, and it was a virtuous circle before, pushing stocks higher. We now think that the worm has turned, and volatility is now entering a new seasonal period where we should expect higher volatility into at least mid-October. And we think that will fuel greater selling pressure on equities from dealers and from quant funds. And I think that could put the market down substantially. And it plays into our wave count and technical view of the market, which we'll get into in a few minutes.
Jeff, I think that's probably the most well concisely put breakdown of the situation. So I really appreciate that, and I think our viewers will really appreciate that. There was, gamma squeeze and gamma and everything. I think are a lot of topics that people aren't necessarily comfortable with, and I think that breakdown was phenomenal. So thank you very much for that. Can we have a look at the 10-year Treasury yields? It looks like they're breaking out a little bit here.
They are. This is an interesting situation. We started talking about it back, maybe mid-May, late May, where we saw 10-year Treasury yields, actually 2s, 5s, and 10s, all kind of tagged their 200-day moving average and started rallying off that level back in late May. And what we started to see here in late July, early August is a deviation whereby what's happening is the shorter end tenors are now they're actually going down, right? So we're actually seeing long rates break out, but short rates are being held more stable, and so we're seeing a steepening of the yield curve. And we talk about this in great deal in the newsletter. In fact, it's kind of our opening salvo. And the point is, what we see shifting here, what's changing today, and what didn't exist earlier in the year, is this re-steepening of the yield curve tends to occur as we're going into recession. Okay, it's the indication that the torpedoes are in the water, so to speak, with respect to a recession. And we use that analogy because we think that the ship is about to be torpedoed, and one of the things that's causing it is this rise in long-term rates. Many people are kind of baffled by the fact that rates are moving higher. We're suggesting that the rising 10-year bond yield might actually be the cause of the recession. It might actually be the cause of the continuation of the bear market. We see this breakout, and this is a classic pattern-based formation of the inverted head and shoulders variety. And what we see on the right-hand side is this very strong right shoulder, right? It's elevated, it's higher than the left shoulder. And what that indicates is that this change has momentum behind it, okay? It's got significant momentum behind it. And I think the breakout, when we get the follow through above 433, which was the prior high in the 10-year this cycle, we could see a rather accelerated move into the 5% range. We have an initial target of 495, but a stretch target up to around 540. And we've kind of illustrated this in a longer term chart that's not in this particular deck, but it's in the newsletter. And we show how we get into that 5 to 5.5 range. We're calling it in the newsletter 533, that midpoint. We think the 10-year bond yield could easily get there within the next year. And so, if we're looking out, say, a 6 to 12 month time horizon, I think it's very reasonable to expect 10-year Treasury yields to see some level above 5% in the next 6 to 12 months. And I think that's going to dramatically change kind of the dynamics in the economy and in the stock market.
That certainly will change the dynamics, that's for sure. Let's have a look at some technicals here, Jeff. Can you walk us through your latest thoughts on the primary degree Elliott wave?
Yeah, so we decided to kind of expand this chart. And as you can see, it goes all the way back to the January 2022 high. And, we kind of went through our own little academic exercise, if you don't mind. We wanted to kind of take a look at the history of, the price action and really kind of see how this whole thing's evolved and where we've made our mistakes. And we kind of go through the details of that in the newsletter. But, I'll try and give you some high level sketches here. So the initial decline into the October low traced out something of a rare Elliott waveform. It's known as a leading expanding diagonal. And it's one of the only, it is the only pattern where wave 4 and wave 1 can cross over. Wave 4 actually enters into the range of wave 1. That's a violation of an Elliott rule under normal circumstances in a normal impulse pattern. But in a diagonal triangle pattern as this, it's allowed. And the reason for that is, well, there's a lot of behavioral finance reasons, and we won't go into all of them, but suffice it to say that this is a rare, I would go as far as to say it's an exceedingly rare pattern, but it's a valid Elliott waveform, and it's this expanding diagonal triangle of a leading variety, right? And that brought us into the October lows. And, one of the things that kind of threw us for a loop is that the fifth wave, wave 5, was truncated. It wasn't longer than wave 3, which is kind of the normal relationship you'd expect. And so we kind of looked at, the June low as being kind of the orthodox low of the initial 5-wave decline. It took us a while to figure out what was happening here. And once we got our arms around the fact that this leading diagonal triangle represented primary wave 1 down, now wave 2 started to make more sense. Well, wave 2 threw us a few curveballs as well. So as you could see that, the B wave of this ABC zigzag structure was actually a flat. We originally counted it as a double zigzag, but after we started to see the zigzag or the second zigzag expanding out into a second a level of 5 waves, we could see that maybe that flat was the better count. So we revised our count. It's now an ABC single zigzag with a flat B wave. And so once we came to grips with that view, we could then understand what was happening in wave C. And wave C was 5 waves where we saw the 5th wave extend, and we actually saw the 5th of the 5th wave extend. And what we see when that occurs is you get this kind of rising wedge effect, if you will. Everything kind of gets narrower and narrower, and you get to this final pinnacle. And right as we were kind of arriving at that, the light bulb went off, and I could see the entire thing clearly. And at the July 27th top, we basically said, well, this is a classic textbook move. And we put the inset chart right out of Elliott Wave Principle. It's page 40. We have the 10th edition. So page 40's actually got that inset chart of a leading diagonal with this zigzag follow through, and it retraces all the way back up to wave 2 of primary wave 1. It's textbook. It couldn't be any closer. And so, we now believe what's happening is we're getting that rollover, right? And that rollover is already, declined in 5 waves. So we know directionally the trend has changed. And so it's just a question of just, filling in the blanks as we begin to see how the subdivisions, trace out, and we can find out what degree of trend we're at. Right now, it's a very low degree of trend, probably something like minute wave or minor wave, but we'll be able to expand that and get a better sense of where we're going. But, we think wave 3 has the potential, and this is primary wave 3 down, has the potential to carry the S&P 500 down into the mid 2000s before it terminates. And that won't be the end of cycle wave A. And as you know, we've been calling for a super cycle degree correction of an ABC type, waveform. And so this is early days of where we are in this process. And I think the process could take years. So many people are focused on the next quarter. you've got the wrong time horizon if that's what you're thinking about. You really need to kind of be thinking about this the sea change, this rise in rates, which is a generational change, right? Is consistent with a decline in equities on a generational basis. We may have seen, the highest high you're ever going to see in the rest of your life in terms of equity. So I think you need to prepare yourself mentally that's the regime that we're in right now going forward.
The highest high in our lives. That's actually a very scary thought. Jeff, how are market internals looking?
Well, that's one of the things that really supports this, Mehdi. I mean, the market internals look, you know, like they've topped. Basically, we're seeing divergences everywhere, right? So as we saw prices make that recovery high in late July, we saw a negative divergence in breadth, so a lower high in net advancing issues. We saw momentum make a lower high, another negative divergence. And then finally, we saw net advancing volume make a negative divergence as well. And now the ratio of up down volume is 1 to 1 at this point. And so it's pretty tough to argue that we're in any form of a bull market with momentum rolling over the way it has, following a big negative divergence, breadth really collapsing around us. As I've been saying for some time, a lot of people were pointing to this broadening out. I saw the rotation under the surface. I think that's all we've really seen is a rotation out of tech, and to a lesser extent, discretionary at this point, into industrials, materials, and energy. And that's really kind of how we've seen this shift under the surface, and I think it's being reflected in the internals.
Jeff, before I harass you about the Magnificent Seven, can we have a look at investor sentiment? How's this looking?
Yeah, another thing that kind of shows us that we're in the neighborhood of the top, and if we look at the name exposure index, this is a 2-week rolling survey, right? 2-week moving average of survey respondents, and the most recent result shows that professional investors are actually leveraged. Mehdi, they got up to 101.8% equity exposure. It's very, very rare if we look back to the historical record to see professional investors get leveraged. They tend to do so at market tops, at the extremes. And so we think bullish sentiment amongst professional investors that basically were chasing a rally that got away from them, just basically mark the top. If we look at the AAII survey below, we see that that's come in quite a bit from its recent high of 29.9 on the bull bear spread. That occurred the week of the July 27th high. And so, if we take a look at what happened, we see that sentiment has peaked or is peaking right now and rolling over with the market. And that is typical. We usually see the highs in sentiment occur just as the market is making its high. And I think we're seeing the evidence of that change in the AAII survey, which basically dropped by 10 percentage points from 30 to 20% effectively.
So, Jeff, I know I just mentioned there, what's going on with the Magnificent Seven? These guys have been kind of our bellwether for a while. Where are we going here now?
Well, not much good over the last week. The only stock in the entire cadre of 7 leading market cap stocks that was up last week was Amazon. It was up 5.5%, right? The flip side of that was Apple. Apple was down 7%. Both of these companies reported their quarterly results last week, and obviously Apple's were quite disappointing, and it's reflected in the stock's price action last week. Amazon's on the other hand were fabulous, right? They were well beyond expectations, and so one has to ask what's really going on in the discretionary space, because Amazon's less a technology company than it is a retailer, and so it's in the discretionary space. It's driving discretionary. It's one of the largest components. It's Amazon and Tesla combined, I think, are like 40% of the discretionary space. And so, Amazon's upside surprise certainly got investors excited. The thing is, Amazon's not making a new all-time high, right? And so we think it's just, a blow off into its recovery high. I think Amazon's probably topping and poised to follow the rest of the Magnificent Seven much, much lower as we see money rotate away from that, crowded tech trade right now into something that's, basically got more value.
So, Jeff, let's take a look at some sectors. Last week you did, and you alluded to it again today, but you did say you liked energy, and it certainly does look like it was the outperformer since we last spoke.
Yeah, last week it was again the only sector in the S&P 500 that had a positive return, albeit it was only up 1.25%. It was positive. The S&P, as I mentioned earlier, was down 2.3, so nice outperformance there. Tech was down 3.8%. Utilities were down almost 5%. Utilities are very interest rate sensitive, and so when you start to see 10-year Treasury yields poking up around their cycle highs, people are thinking, okay, I was long utilities for the yield. Now I can lock in treasuries for 10 years and get the same or better yield, and it's risk-free. And so, you're seeing some of that rotation going on. So that's likely what pushed utilities down so much. But, I think the real pair there is long energy, short tech right now. And I think if you look at the valuation of those two trades, I mean, you take a look at, a PE of around 11.9 times this year's earnings on energy versus 29.1 times on technology. I mean, you're looking at energy trading at about a 50% discount to the market and tech trading at a 50% premium. And I don't think that premium is justified, especially after we saw Apple's earnings report.
So, Jeff, you've kind of broken this down for us over the course of our conversation, but let's wrap with a nice little sector relative strength analysis on some of the sectors of choice or not so choice.
Yeah, we use this rotation graph to really illustrate what's going on, and I think it's a great pictorial view of what's really changing. And what we're seeing is over the past 4 or 5 weeks is that communication services, technology, and discretionary are losing relative strength momentum. They're rotating to the downside out of the leading quadrant into the weakening quadrant. On the flip side of that, we're seeing industrials, certainly on the cap-weighted side, on a leading basis. We're seeing materials and energy, pushing up into the improving category. And so, I think there's this rotation underway where tech and comm and discretionary you're seeing flows rotate out of those sectors and into industrials, materials, and energy, not necessarily in that order. And I think there's a big fundamental shift underway because there's a lot of legislation that's been put in place over the last 18 months. You've got the infrastructure bill that was $1 trillion. You've got the CHIPS Act. That's another almost quarter trillion dollars. And then you've got the Inflation Reduction Act, another $250 billion that are specifically earmarked for infrastructure, right? And that infrastructure spending is going to sustain for the next 10 years. It's basically earmarked for disbursement over a 10-year period of time, but it's very front-end loaded. And so the biggest beneficiaries of that spending, that fiscal stimulus, is going to be industrials, materials, and energy. Simultaneously, you've got, OPEC basically controlling supply on the energy side, controlling price on their exports to Asia. And you've got the U.S., in a situation where their SPRs are now down at a 40-year low, and they're forced to refill these. And even though they don't want to refill them at $80 a barrel, they may have to at some point because oil may run away from us. Our view is that WTI could see $90 a barrel before year end. And we know that the U.S. already has contracts for delivery in August and September. Our suspicion is we'll see them build up, a series of new deliveries into the rest of the year as well. They're going to want to get their SPRs back up at least to 50% of where they were at the beginning of 2023. And our suspicion is that that process is just underway.
So, Jeff, I want to thank you for that, as always. And I want to remind our viewers that you still obviously publish your top actionable trade ideas. You've got 5 longs and 5 shorts. Hey, why don't you give us one before we wrap? Just a little teaser here, Jeff.
Well, okay. The one that I would talk about is on the short side. And I think that the shares at General Mills put in a classic double top formation. And the break below the neckline, it looks like we could see a pretty aggressive move to the downside. This is a blue chip stock. It's a Staples name. Staples are, dramatic underperformers on a relative strength spectrum right now. And, it looks to me that, Mills has really been benefiting from their ability to pass price increases through and maintain their margins. I think they hit the wall on that. I do not think people are willing to pay, 1 penny more for Cheerios. And at the end of the day, I think that we're going to see a lot of discounting, a lot of coupons on cereals. You're seeing the same thing from Post Foods and Kellogg, and a number of other companies are starting to do this. I think you're going to see General Mills across the board experience margin compression, and that's going to affect their earnings. And I think the stock is topping and it's poised to roll over. I'm not going to throw my levels out there, but you can flash the chart up, and anybody who wants to take a quick shot of it, feel free.
Fantastic. Thank you for that, Jeff. And I'm definitely going to keep an eye on my children's Cheerio consumption at this point. As mentioned, don't forget to check out the content on hugeinsights.substack.com. Until next time, thank you for watching and good luck investing.